Hello guys, today let's talk about the perspective for tech companies. So will they do good in upcoming months when Fed will begin tapering, most likely in November, and start raising interest rates next year? So what about the current situation when bond yields started to rise? Well, let's discuss that and more. And I need to apologize in the beginning because some of this stuff might sound a bit complicated, and I will try my best to put it in the most understandable manner. Okay, so do treasury markets foreshadow impending trouble for the tech companies and tech-related giants who have driven this bull market? Some experts say yes. They are based on the observation that the rise in interest rates, and treasuries, coincided with the short-term declines in tech stocks at various points this year, including now as well. With the Fed signaling the quantitative easing is about to end, many believe that further increases in interest rates will mean difficult times for tech companies and their like. History shows, however, that raising rates are not automatically negative for stocks of growth companies. People afraid of rising interest rates argue their fear of a phenomenon whose mechanism of which works as follows. So when the rates of return are low, investors are more likely to buy growth-oriented companies, expecting large profits in the future. Rising interest rates, on the other hand, suggest that investors are more optimistic about the economy, so they allegedly prefer companies that can benefit most from stronger economic activity right now, meaning they are primarily high-value equities. So to support this claim, analysts cite a number of data from recent periods when interest rates were rising. For example, the Wall Street Journal reported a $1.2 billion outflow from mutual funds and ETFs, exchange-rated funds, in the week ending September 22, the first net outflow in 3 months. So others noted that tech stocks fell as interest rates rose this year, using ETFs with a high share of growth companies as a proxy for the sector. Looking beyond that, the reality is not that simple. Recent history proves that the tech sector can do well with the rising interest rates. In the period from 25th July 2012 to the end of 2013, the yield on 10-year Treasury bond increased from 1.43% to 3.04%. During this period, tech posted an increase of 36.9%, slightly behind the global markets, which reached 42.3%, but still in style. Or consider when profitability increased from 1.37 to 3.24 between July 8, 2016 and November 8, 2018. Tech returned by 69.7 during this period, more than double the return of global equities by 30.8%. In the long term, tech was both gone up and down in a variety of interest rates environments. There is no set pattern here. Over the past 2 decades, the correlation between tech's relative returns and government bond yields has been minus 0.10. As a reminder, a correlation of 1 means that the datasets move identically, while minus 1 means that the datasets move completely opposite to each other. So a correlation of minus 0.10 means there is no relationship at all. High-value firms, which typically have lower credit quality, are heavily reliant on bank lending because they do not have as easy access to capital markets as large growth firms. Banks provide short-term loans to finance long-term loans. Consequently, the difference between short and long interest rates is an indicator of the bank's net interest margin, the potential profit on new loans. So, with the shorter rates close to zero, an increase in long rates means a greater potential profit. This makes risk-taking more profitable, and therefore a steeper yield curve encourages banks to lend to a wider range of borrowers. However, I do not think long-term interest rates will continue to rise and remain high. Inflation is the main determinant of long-term interest rates. While inflation rates are currently elevated, I believe they are due to a combination of temporary factors, such as the reopening of the economy and global supply shortages/lockdowns. The likelihood that they will continue to drive rapid price increases seems slim, especially considering all investments in new production capacity. In overall view, inflation is likely to return to a slower pre-pandemic pace. Note also that the QE tapering did not have a lasting impact on the rates in 2013 and in 2014. Volatility is normal, and reacting to it can be as dangerous as reacting to downturns. White markets do not follow gradual, smooth lines, and neither do market subcategories. Moreover, volatility is often accompanied by sector and style counter trends that may end as soon as they started. So in my opinion, reacting to short-term unpredictable movements can lead to mistakes. Instead, it is suggested that the traders look beyond the immediate short term and look at the 3 to 30 month time frame, over which markets tend to wade in. Although last week they were not tumultuous, in fact, the long-term economic factors that stocks depend on have not changed that much. Most major economies are near or even above pre-pandemic production levels, and growth is slowing as expected after the reopening-related surge. So this slow growth environment is likely to resemble the pre-pandemic environment that favored large growth-driven companies. One that can boast large gross margin that can hedge against the cost pressures currently affecting other industries. So technology and similar to tech stocks have performed the best in the pre-COVID environment, and I would expect them to continue to lead the way despite occasional counter trends. With that, I would end this part, and now maybe let's switch to the platform and discuss how the portfolio is running, because as you maybe watched the previous videos from the month of October, from the first day, we started the project with the monthly portfolio, which we were choosing the best stocks for the particular month. And right now, 2 weeks have gone, so maybe almost 2 weeks. So it is a good time to review the portfolio, which stocks are currently best performing and which stocks are currently underperforming, we can say, because we choose 4 stocks in strictly SEC parameters and 4 stocks that I choose by more or less what I am feeling about those companies. So it is basically the comparison of 2 portfolios when we choose the stocks that are based on strict some rules, some strict parameters, and those who are chosen by, we can say, sheer luck, sheer pure, we can say flip of a coin decision-making process. So yeah, let's switch to the platform. Okay guys, now we are in the client's cabinet in LiteFinance, and yeah, let's check how the stocks are performing. Current change we can see is minus 22 euros almost, and we have the list of the stocks which we can deduct. First 4, counting from the downside, are based on the strict criteria that I choose to when creating this portfolio, and the last 4 are based we can say more or less with the flip of the coin and the, we can say, feeling that I have towards those stocks. And yeah, best performing stock we can say is currently Home Depot, which is a home furnishes retailer. And the worst performing stock is the Moderna. So we can say everything goes as we expected, because, for example, Moderna is a company that currently have good fundamentals and good overall market situation is in favor of this company, because we all know what they make. They make the vaccines for the most popular disease on the planet right now. And if we were digesting their fundamentals in the previous video, we were seeing that Moderna is more or less company without any stable revenue, stable income. They are based, their earnings, their revenues, they are based on one-time events such as this last one that is currently going on. And basically, that is what we could expect, what we would expect from such a company, especially if we add the fact that the October is the most volatile month of the year. Maybe let's go now and check the charts very briefly. But let's switch, maybe not to Apple. Let's not talk about Apple, but let's check Facebook right now, because yes, we touched the 200 period moving average, and yeah, this is the level which we talked about in the video about Facebook and the situation that currently surrounds the company with the whistleblower and the concerns about making profits and being a safe platform for the users. So if you're looking for an entry on this stock, I would rather look for a long trade, either to the very long-term investment or even for a mid-term, for a couple of weeks, months, etc. This is a good moment. This pullback, this correction is an ideal moment, even right here when we touch this 200 period moving average. So historically, we can check that recently it was a good moment to re-enter the market, and right now I think that as well. There are two strong fundamentals. We were talking about that in the previous video, that Facebook has two strong fundamentals: that one of the highest margin on the market, and the business model and overall the current market situation is very healthy for the company. And the market overall is watching for the strong fundamentals. If we are entering the market, even if we had even a little bit deeper pullback, in the perspective we talked about from 3 to 30 months, market is waiting on fundamentals, and fundamentals are very strong with this company. So only to the upside. That is as for Facebook. Maybe check the Apple. Okay, let's check the Apple right now. So as for the Apple, we said also it was the whole, we can say, speech a couple minutes ago was concerning Apple as well, because it is a tech company. And I also was mentioning previously in previous videos that Apple is one of those companies that I think will do the best during the we can say hard times, because firstly, Apple is a very strong brand. It has high margins, so it is there is a lower risk that the company will have some problems, financial problems. And the second thing is that it is as I said, it's a strong brand which can weight all the costs of the production onto the clients and just charge more for their products. And who doesn't buy Apple? Me. But yeah, overall, I think that this company is very healthy, and right now the current situation is very in favor of the bulls at the moment. So overall, as for the direction, I would also not dare to sell at the moment, because firstly, we are on the support, and secondly, we are creating a reversal chart pattern. And if it is created on a very strong support on a higher time frame, like daily, it would be too risky. I would rather open some long trade, as basically the same situation as with Facebook. It is rather a good opportunity to re-enter the market to the upside rather than look for shorts at this stock. So maybe what else we can check? Maybe let's check Qualcomm, which was performing badly recently. Maybe let's look. Okay, so I understand right now we are below the 200 period moving average right now, and we are sitting on very, very strong support right now. Let's zoom out a bit. Okay, that's the thing. Let's also check how when the Qualcomm is publishing its earnings. Okay, so we see that the earnings are due to be published on November 3rd, and the forecast shows that the earnings and the earnings per share are about to be higher than compared to the previous quarter. So if you go back to the chart and we can compare the recent fall of the price, it is 150, 122. So a quick math, it will be around 15-16% from that moment. So it is still a correction, and I would rather look at it as a good moment to re-enter the market to the upside rather than look for the opportunity to sell the stock. So next, what we can check is what we had on the, maybe let's check modern. So as for Moderna, for the stock price, we see that the psychological level of 300 was held at the moment. There was no clear resistance if we look at the charts. So only the psychological level was something that could stop the price from falling further, could act as a support at the moment, and it did. What we need to have in mind, as for the fundamentals of the company, we were talking about that they are the company of one-time events, and they don't have some regular revenue streams and earnings. They are basing on the one-time events such as the recent one that occurred, and the other thing that they still have running contracts, they still have orders from the governments that they need to fulfill. So basically that's the thing that's the revenue stream at the moment, and it will last for at least a couple of months. So the fundamentals are still there for this company, and if what we need to wait is for the earnings, which will occur on November 10, right? I think that TradingView shows me the correct date. So on November 10, the company will publish their earnings, and at the moment I'm looking also at it as a rather buying opportunity rather than selling opportunity.